Hello, 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 everyone. We are on the backside of Thanksgiving, and we're all looking forward to what is to come, which is the Christmas season. So, thought it would be a very good time for me to take the opportunity to stop by and have a little chit chat. Just to refresh your memory, I'm David Etienne of Etienne Business Solutions, certified public accountant. Usually at this time, we try to huddle, so to speak, to sort of review a couple of things that are important to be considered as we approach the end of the year. So many things to consider in the financial lane, whether it be from an individual point of view or from a business point of view. Quite often, though, we tend to focus a bit more on the tax implications or the tax related factors that need to be considered during this time of year. It is my view, however, that, and it is a fact, that your tax processing and deliberations usually evolve out of all your financial activities. Okay, it's the end results of all your financial dealings that end up flowing through into your year-end or beginning of the next year tax returns. So it is very important, I consider, that we look at some of the planning activities that may not be considered to be strictly tax planning, but more business planning, financial planning. And we're not going into any great depth here because it's just more tax focused. But I just want to point out a couple of things too that we ought to be thinking to make the tax planning portion even more effective. So very quickly, we are today's the first day of December. So we have gone 11 months, and frankly, we have 1 month to go. Most of us, traditionally, we wait until January after all the celebrations are over to turn ourselves to taxes. But there are a couple of things that we should be considering even before the year closes. And those are some, and you'll see, and you'll hear people talk about, some things that you should consider before the close of the year. The first thing I want to touch on is for those, and I'll come back to individual. I just want to quickly touch on business owners, small business, whatever, business owners. Know that you are at on the first day of the last month of the year. It is a good time to reflect, to sort of look back at your activities, your financial statements between January to end of November to see where you are. Because at this juncture, you will know, okay, given where I am now, so for the next 30 days, the next month, December, where I would likely to be, and therefore make some plans. Now, some of the quick things that you can institute for that last month to say, okay, given my total revenue and whatever tax bracket I'm in one way or the next, then I may want to consider how to treat the revenues that I'll be earning for this last month of the year. Because you may find that it is advisable for you to take steps to postpone revenues. Although they are 2025 revenues, you may consider it wise to postpone receiving those revenues until early 2026. By so doing, they would not be included in your 2025 tax considerations. Everything we talk about when we talk about tax planning, business planning, it is always going to be individual and client specifics, okay, specific to that individual or that circumstances. So we're just throwing out things to you that are worthy of considering, but some may apply, some will not apply, and those that apply will have to be tailor-made to your particular circumstances. So that's one thing one would want to consider. So that we talk about the timing of sending off your invoices. So very quickly, because it's a very short session, you'd want to time that. The other thing to think about is whether or not you would have ended up with any capital gains, because you may have had transactions in financial, some financial transactions, some transaction in asset acquisition or asset sales, things like that you want to look at, because usually at this time of year, you can determine whether or not you're likely to have some capital gains, which will be taxable. And then there's a possibility of you looking at your portfolio and seeing what loss incurring securities I have that I could then dispose of to, or as it were, realize those losses, which would help now to balance out or mitigate the tax effect on whatever capital gains I would have made. That's another thing to look at. There are a lot of what we call tax credits. Now remember, a lot of these credits are available to us as business people. And the good thing about those credits is that, as you will know, they are really dollar for dollar deduction from your potential tax bill. Very important to pay attention to those things. Important to also bear in mind that a lot of these benefits are based on certain income and revenue threshold. So once going back to my first point, theoretically, if there's a particular credit that will totally phase out or will be totally unavailable to me if my income is above, say, $500,000 for the year, then if I'm at 450 or say $400,000 at end of November, I may want to think and say, okay, how do I manage my revenue to be earned for the month of December so as not to go over the $500,000 revenue threshold, so that I do not deny myself of that tax credit. You see, so these are some considerations that needs to be pondered on. And quite often, if you are in the know, if you're knowledgeable, you can do that yourself. If not, you need to consult. Let's just quickly now look at some other thing that applies to the general tax-paying public. Deductions. The usual thing, you always have your standard deductions or your itemized deductions. Year over year, the IRS will make a little adjustment, a little upward adjustment in the figure for the standard deduction. But as you know, the standard deduction is really what you automatically is entitled to, and the figure is dependent on your filing status. That's a given. You may opt now to have your itemized deductions instead of using the standard. And so, because maybe the itemized deduction give you a bigger number, which will be of more value to you. The important thing to remember is if you use your standard deductions, there's no need or no requirement for documentation and records. But if you opt to go with your itemized deductions, then in the event that you have some review, some audit, you will be asked to present the proof, the substantiation for those deductions, okay? Whether it be charitable contributions, evidence of your property tax, etc., etc. So those are the things to consider also. And I'm right now, it's quite a number of things. I'm just picking out the very important ones very quickly. Now, we talk about retirement accounts. Yes, it is now time to look at that. As you approach the end of the year, you want to see, did I max out my retirement account? Meaning, most retirement accounts, whether they be employer provided or they are your own account that you open, they usually have a maximum contribution level per year. You want to quickly look to see what you have contributed thus far. And so if you're short by a couple thousand, you want to take steps to say, okay, let me quickly get money into my retirement account so that I take the full benefit of the contribution limit. Because remember, all those movement of monies into your retirement account will then reduce your taxable picture, at least for now. So that's a good tax planning tool. And at the same time, it is, as it were, bumping up or bolstering up your personal account, your personal retirement account. As I said, whether it is employer or or self-providing. Very important. Your charitable contributions. Yes, it is true that nobody gets, the IRS does not give us a dollar for dollar deduction on charitable contributions, so that if you decide I'm going to give to my church, say $10,000, you will not get the benefit of a $10,000 write-off that kind of way. But the point is that because charitable contribution is a part of your itemized deductions, then it definitely will benefit you if you are going to make those contributions that you made them on this side of the year, if you want them to be included in the list of itemized deductions that you're hoping to claim on your 2025 tax returns. So we talk about the maximum your retirement account. Now, there are two accounts that's very important. One is called a health savings account, your HSA, and there's also your there's this other account, and if you soon come back to mine. Now, your HSA is where, yes, you would have through your job contribution made to it. It is for all of your health related expenses. So you want to basically tap into it. The good thing about your HSA is that the HSA is what do you call it, transferable, so that you may not take the full benefit, but you have not lost it because you transfer over to the next year. Your FSA, however, would be one that is like your flexible spending account. Then you want to utilize it because that one is a year specific account where if you're entitled to say $6,000-7,000 in your FSA account, you need to use it. And that is why come year end, you will see providers of like dental services, optical services, etc., putting out big advertisement and say, make sure not to lose your benefit. Make sure you come in, set your appointment to get your eye examined, to get your dental work done, etc., etc., because they're aware that those accounts have an amount that if not spent or utilized by year end, you would have lost it. So those are some of the things that we also need to pay special attention to. Again, we are here at 1st of January, 1st of December. Now, remember the implication for Social Security, of any other income earned. So quickly, if you're receiving Social Security, two things can impact your Social Security benefits. One is that if you are earning other income separate and apart from the Social Security, depending on how much of that other income, you may find that the Social Security benefit that you receive is reduced in terms of dollar. It is reduced. What you get from the administration is reduced. Now, you may say that it's a balancing act to say, okay, if I'm going to be earning much more than the amount of reduction in the Social Security, it may be worth the while. But you need to bear in mind that the additional income you're earning that is causing your Social Security benefits to be reduced may be additional income that is being taxed. And so after the tax of that additional income, you may find that you are actually on the losing end. So that's another part of your planning. Do I want to, know that I'm at November or 1st of December, do I want not to regulate the amount of overtime work that I do so that I do not pass a certain income figure that is referred to as other income? And so by taking that proactive action, I will prevent any of my Social Security benefits from being denied, from me being denied. That's one thing. The second thing is the tax implication. Normally, yes, you'll get your Social Security benefits during the year. You're not paying any taxes on it. Come tax time, you file your taxes, you report it. You're still not paying any taxes on it. However, here comes again the whole aspect of other income. So there's a formula that is used to work it out. But essentially, if you're earning these other incomes along with your Social Security benefits, it is possible that some of your Social Security and maybe up to 85% of your Social Security benefits could become taxable income. Okay, so there's a difference between the amount paid out to you being reduced as a result of the other income, separate and apart from the amount that you receive could then become taxable. A portion of it could become taxable. Those are things, again, that needs to be carefully monitored. Sometimes the question is asked about purchasing something, an asset at the end of the year. Now, bear in mind that when you purchase an asset, let us say you're a carpenter and you decide I'm going to buy one of those big electrical saw. Okay, that's your tool of trade. That's your asset. That's what you intend to keep in the business to earn income in the future. So that is not something that you can say, okay, I bought this saw for 5,000. I'm going to be able to deduct the full 5,000. That's not necessarily the case. Usually, you actually have to, what to say, capitalize it and depreciate it over time. However, there is good news because we now have what is called a 100% deduction bonus depreciation as being or reintroduced for up to say in 2025 here. So what it means is that you are given a special provision or special opportunity now to really deduct fully 100% of those purchases. Again, you need to see what type of business you're in, what kind of equipment and tool you may require, ensure that these qualify. And if they do, you want to be proactive, jump on board, buy these things on this side of the year so that you're able to do a full 100%, what they call bonus depreciation, by basically writing it off as if it was a normal business expense fully instead of having to spread it over time. Okay, and note now, what we're trying to look at are the things that you need to quickly address, quickly think about, quickly put in place before the next 30 days if you want to benefit from them on this side of the year. There's a lot of people have been benefiting from energy credits, clean this and clean that, solar this, solar panel, etc. But basically it is home, residential energy credit, clean energy credit, etc., etc. Well, 2025, this 2025 tax year is when these things will come to an end. So if you have any purchases that was done that you think qualifies, you need to claim them this year. Or if you're contemplating purchasing any such devices that would qualify for this energy credit, then you need to move quickly to get it done so that you can then get the benefit of that of those credits. I see energy credits, we say tax year 2025, which is the end of this year, is when you'll be able to benefit from them. So do not leave that purchase until 2026 if you intend and you hope to be able to benefit. There is the one benefit that a lot of businesses were really happy about, but they were also very wary. I always say business, even individuals who have their own little activities going on, was what we call the qualified business income deduction. Okay, that's a very good one where we say people who operate businesses that were not classified as corporations were given this special benefit of a deduction, okay, qualified business income deduction. And it was basically for mainly, we call it pass-through people. It was poised to end at the end of this tax year, but fortunately Congress decided, no, we're going to keep it. But not only keep it, but extend it into perpetuity, okay, make it an institutionalized provision. So you're able to continue to benefit from your qualified business income deduction, which is a nice chunky percentage of your income that can be put aside and get that benefit. So again, something to look at and look at it very, very urgently. When we talk about the entertainment, the hospitality industry mainly, then that's the industry that deals with tips. You go into the restaurant, you go to a bar, a nightclub, hotel. That is where we have prominent tip activities going on. Tips are, yes, they are just another source of income, but they have special treatment. And so you find that the tax rules for tips tend to be a little different from regular income that you earn. Now, the good news is that tips up to $25,000 will be exempted from tax. That's very good, very, very, very good provision, because you may know that a number of persons working in the hospitality industry, they have their salary, their compensation made up of two portions, like a base amount plus tips, and that together give them, their compensation. And so tip is a very important component. And to have up to 25,000 tips for the year tax exempt is a big boost. And so bear that in mind. Now, I don't know if there's a way to strategize to say, okay, Mr. Employer, can you pay me more of my income through tips? As opposed, I don't know that there's a possibility or that there's such a provision. But the bottom line is that if you were earning up to, say, 10, 15,000 tips and they were being taxed, the good news now is that that threshold has been moved up to 25,000, so you can earn up to that without it being tipped, without it being taxed, without it being taxed. Auto loan interest. When you buy your motor vehicle, you make your monthly payments, and your monthly payment has two components. Paying the principal, which is the cost of the motor vehicle, you're paying in installments, but in addition to that, you're paying interest. Naturally, it's a loan. Okay? In the past, the interest component on this motor vehicle, this personal motor vehicle, was not tax deductible. It was not tax deductible. There's a change now where up to 10,000 of your interest on that motor vehicle, you're able to deduct it. And so all of that is very, 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 very good news to bear in mind. I'm trying to pick up the salient items here. There are a number of other provisions which will be more industry and individual specific, but I think we want to look clearly at some of the things that will apply to almost, most of us regular taxpayers. Good. Having said that, let me step back and say that as I started, most of your tax planning and your tax strategy is going to be individual and business specific. Yes, although 5 persons qualify for a particular benefit, you may find that the extent and the way in which these 5 persons benefit is different. Why? Because all of these things are driven by income, they are driven by your filing status, etc., etc. So the best way to approach your tax strategy is to be informed. And quite often you will find that getting expert professional advice to see if you qualify, how you go about accessing that which you qualify for is always a wise way to go. You would have your year-over-year tax preparer, which may be just a tax preparer or maybe a person who offers tax preparation and some tax planning. Whatever the case is, you need to tap into those resources. At ATN Business Solutions, we operate a very robust tax planning platform where we try to guide our clients throughout the year on what to consider, what to do. Do not wait until end of year. Okay, be proactive. Although we have this ongoing approach, come this time of year, we intensify it because we want to ensure that our clients are on the right track. During the year, we have consulting provisions where clients can at any time book a consultation, whether virtual or in office, but mainly virtual now, where we can go through specific needs and requests and requirements and questions that they have. We still have that, and the normal way to make this booking is to actually, and you can see it at the bottom of my screen here, go onto our website, or you can actually call in the office. Number is right there, but you're able to book a consultation for specific tax planning. The good news this time is that outside of the regular scheduled 45 minutes or so, which is all regular consulting work, what we're doing for this year is to offer a 1-hour consulting session, strictly specific tax planning session for 1 hour, but we're keeping it at the same regular rate as in for the 45 minutes. Okay, so here again, you can just go set up your appointment and be very mindful that if you intend to take up this offer and benefit from this, you need to go online, book, or call the office by 12 p.m. tomorrow. So we actually do it between 12 now, which is the time of this airing of this the presentation, to 12 tomorrow, 12 p.m. tomorrow. You can call or go online to book yourself a consultation. That is a window that is open for you to say, yes, I want. No, it is not saying that you have to, we have to have this consultation between now and 12, but you have to make your booking, confirm your booking, and indicate what is a convenient, comfortable time for you to, for us to join and go through your specific. So that is what I would like to share with you. Very short, very to the point, and I want you to just pay attention to your circumstances. Think about it and decide if it's something that you think that you could benefit from. Okay. Well, thank you very much for stopping by to listen to my few tidbits, and keep on planning. And the last thing I'll say to you, although we normally talk about planning for the tax season, for the year end, most of your planning are things that will flow over into the new year, because your planning for the current tax year is always a very important tool for planning going into the new tax year. So even with this consulting session that I'm offering, we'll talk about your 2025 strategy, but also how it moves over into proper planning for 2026. That's my bit. Thank you again for joining me. I'm David Etienne, your CPA, wishing you all the best between now and Christmas and into the new year.